Let's start with some inflation data. Last week we got CPI and PPI. So let's just dig a little deeper in here and see where the problem lies. On the screen, I have the price index itself, 2023 and 2024 for January through to December. We don't have December's number here. We just got November's number. So I can't break it down in even amounts. So I've taken the first 4 months, then the next 3 months, followed by the next 4 months, and looked at year over year. So for the first 4 months, January to April 2023, the price index increased 1.265, 2024 1.013. That is some 20% lower. Nice. Next 3 months, 2023 0.785 versus 0.394. That is half the speed. Nice. And for the final 4 months, 2023 was 1.102 and 2024 was 1.187. There's your problem in there. If we look at January all the way through to November 2023, 3.185%, 2024, 2.614%. There's progress. If we look year over year, November of 24 over November of 23, 3.3%. November of 23 over November of 2022, 4.015%. Again, progress there. If we take just the last 4 months over here, and we annualize it, 3.34% for 2023, 3.6% for 2024. There's the problem, is inflation in the last 4 months has not just been stubborn, but has ticked up over 2023. It is a 4-month annualized run rate higher than 2023. But there is, within PPI, some evidence that what is happening here is a whole bunch of demand is centering on products that would suffer under Trump tariffs, that consumers and businesses are front-end loading a whole bunch of stuff now to get ahead of tariffs, because we don't have, at least it appears, we don't have something that is broad-based. So inflation is a measure of the change in the price index, but that's not enough to call it an inflationary pressure. It must be a broad-based increase in the price level. Because every now and then, let's say you have 5 prices, you can have prices do this, 1, 2, 3, 4, and then one of them does this for a period of time because there's something particular to that series, which would cause the price index to suggest that there is larger inflation month over month because of that one thing or those few things. For it to be inflationary, you'd need something like this over time. You can have one like this and one like that, but yes, 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 no, yes. Whereas here it's no, 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 and really yes. Well, this is what we're seeing is some of these, and they're in categories that line up quite well with where Trump tariff threats are more likely to show up. So I think what we're seeing through October and especially in November, and I'm pretty sure we'll see it in December as well, is the continued front-end loading of goods into the country ahead of these tariffs from both businesses and from consumers. We'll just take a closer look at Table A. This is percentage change in CPI. We have seasonally adjusted changes from the preceding month and unadjusted 12-month ended November 2024. Just as a bit of insight, why are these seasonally adjusted and this is unadjusted? Shouldn't this be seasonally adjusted if we're comparing? There is something different about a November versus an October, but there is nothing different between a January to December and a January to December, right? You have all of the seasons in each of these, so when you're looking at year over year, you can use the unadjusted numbers because there is no need for a seasonal adjustment because the year over year has all the seasonal adjustments. If you're looking at November over November, it's the same month. You don't need a seasonal adjustment. But if you're looking at November over October, those are 2 different months with 2 different types of holidays, different numbers of days. You would need a seasonal adjustment. Just something for you there. So when we're thinking about inflation, we're really looking at all items less food and energy. This is called core. This is the important thing, because food prices can change for reasons other than inflation and inflationary pressure and demand. There are a whole bunch of supply issues associated with food. And same with energy. There are a whole bunch of geopolitical and supply issues associated with energy as well. So usually, since these items have a high variability in them, usually strip them out to get to what the core is, and the core is what is paid attention to. This is CPI. The Fed looks at PCE, not CPI. CPI will always run higher than PCE because CPI looks at a fixed basket of goods all the time. Whereas PCE says, well, hang on, let's look at what consumers actually buy. Because let's say a steak dinner went from $40 to $50 and it's in the CPI basket. Sure, it would show price inflation on a steak dinner. But what if nobody bought it? If nobody bought it, then nobody experienced that inflation. That's what the PCE will do, is it measures what people actually buy as opposed to a fixed basket of goods. The PCE will include substitution effects. So we tend to look at that one. But let's look at what we have here in commodities less food and energy unadjusted, the year over year. Look at the goods, all negative. Look at the last month here, November over October. New vehicles 0.6, used vehicles 2%. These are big numbers month over month, and that is probably to get ahead of the Mexico and Canada threatened tariffs, because if it's 25% across the board, it is going to raise vehicle prices by several $1,000s. So you may as well get ahead of it. Now, medical care services 0.4. This is nothing higher interest rates can solve. Everything else seems to be very well behaved. And if you go into the schedules and look a little bit deeper, you will find that most of the categories have a large import component to it. Okay, let's get to PPI. This was the grief factor here. Services is nice, 0.2, but goods, 0.6, almost 0.7. There it is right there, almost 0.7. It is 0.7. But this breaks it down. Final demand for goods, final demand for services. I have explained this many times, but in case you're not really sure, CPI measures what the consumer pays. PPI for final demand measures what the producers receive. It's just the other side of CPI. So CPI is what the consumers pay for and only what the consumers pay for. PPI is what they receive regardless of who paid for it. So health insurance. Consumers pay for health insurance, but health insurance pays for medical services. PPI would measure the inflationary impact in those things regardless of who paid for it, minus taxes, because PPI doesn't measure tax, but this is plus tax. So if you have a sales tax increase, CPI would increase, but PPI wouldn't. This is for final demand, not intermediate services. There are two sides to PPI: final demand for goods, final demand for services, and intermediate demand, stage 1 through stage 4. That is price pressure within the supply channel. But this is just the other side of CPI. That's all it is. Final demand for goods, total 0.7, right here. That is not good. Take out foods, 3.1. Take out energy, 0.2. Less food and energy, 0.2. Yeah, that's perfectly fine. 0.2. That's perfectly fine. 3.1. What's going on here? It's mostly in poultry and beef. You have bird flu, so get rid of those eggs, get rid of those chickens. You also have a type of infestation in cattle, especially in Latin America, Panama, Costa Rica, Mexico. There is, I forget the name of this particular infestation, but it's affecting cattle. And you also have massive increases in imports into the U.S. ahead of the tariffs. So, for instance, cattle prices, the U.S. imports 4.5 billion pounds in 2024 so far. 4.5 billion pounds of meat. Cattle prices are at an all-time high, 190. No, I shouldn't say all-time high. They're at that an all-year high. It might even be an all-time high, 1.92, based on cattle futures. So that is importing to get ahead of the tariffs, while at the same time you have an infestation problem in cattle that is reducing the amount of supply, and that's where you're getting things like this 3.1%. But if you strip it out, 0.2, nothing wrong there. Final demand for services total 0.2, trade 0.8. That is a measure of margin. Transportation, warehousing negative, others 0.1. That's nothing. So if we really want to strip out these isolated effects, you got 0.2 and 0.1, which is really nothing. And if we go to CPI and look at November, yes, it's a slight increase, but if you keep in mind that there is some rush to import certain things into the country before the tariffs take place, that is going to put some pricing pressure to the extent that supply channels can't handle as much as the demand is for them. Moving on to rates and yields, we'll just jump to the big story right away. The 3-month to the 10-year, we're looking at slope. Look at this, upward sloping. 776 days, did not exceed 788, but still a mighty fine number there, 776. That's a big one. Canada, upward sloping on the 3-month to 10-year by half a basis point, on the 2 to 10-year by 16.2. US is up 15. Curves are now upward sloping, except for the 3-month to the 5-year. That's more important in Canada than it is in the US, because Canadian mortgages are benchmarked to the 5-year. And you had a decrease in money market rates and an increase in capital market yields, a twist of the curve around the 6-month mark. Looking from the 5-year out to the 30-year, basically a increase of roughly 25 across the board. And we are expecting on money market rates to get a decrease of 25 basis points. Probability there, 93.4. We get that in 3 days, or we get the meeting in 3 days. But more importantly, we get the summary of economic projections, which will give us a terminal rate for 2025, where the FOMC sees rates ending at 2025. I'm thinking the middle of that distribution will be somewhere around 3.25 to 3.75, call it 3.5, but somewhere in that range. Canadian CPI we get in 2 days. I don't know that that's going to mean much. I think other things are more important right now. Bank of Canada did deliver 50 basis points. I think the Swiss National Bank did as well. ECB did 25. China is announcing a whole bunch more stimulus. It seems the easing cycle around the world is well underway. Will the U.S. continue to follow suit? U.S. retail, first of all, let's finish up with Canada here. CPI 2 days. I don't think it's going to matter very much because I think the market is looking at the 2 Ps with Trump, right? You have policy and you have punishment. And this is how it works with Trump. Trump's opening move for policy is, I'm going to punch you in the face. Now, negotiate your way out of that. What are you going to give me so that I don't punch you in the face? And you better give him something. If you say, well, we'll just defend ourselves and we'll punch you in the face. Okay. Now it's punishment. And policy is gone. Trump threatened tariffs on Canada. Trudeau flew down to Mar-a-Lago, attempted to bend the knee, came back and just ruined it all with his woke shit. Twice He says the U.S. has had an opportunity to elect a female president, and twice it failed. I remain a proud feminist. Like, come on, man. They elected people freely. You had flawed candidates. It's not like basically trying to say the Americans are sexist and that he's not and he's above it all and he's a better human being. Well, policy's gone. It's going to be punishment now. Trump doesn't like him anyways. You also had the Premier of Ontario saying we'll just shut off electricity supplies to the U.S. And you had the BC Premier also saying, yeah, we can stop the export of a whole bunch of things that the U.S. needs. Well, that's fighting back. Well, now policy is gone, and now it's punishment. So I don't think the the CPI in 2 days is going to matter at this point. The Canadian dollar is weak and getting weaker. U.S. retail sales in 2 days. Bank of Japan in 3 days. Expect a big nothing from them. The final look at third quarter GDP in 4 days. I don't expect that to be market moving. And you have PCE in 5 days. The big show, folks, is the FOMC and the summary of economic projections. I expect that will probably show the terminal rate for the end of 2024. On the low end, to be 3.25. On the high end, I think 3.75. So let's say 3.5 is what the expectation, at least I think, for the terminal rate would be. But I think the course of events over 2025 will push that lower from where that is. But I think that from where we are now, I still think that they'll come in at a 3.5 on that one. Reverse repo, 135 billion. Reserves, 3.2 trillion. 22 between 22 and 23 months at runoff at 40 billion. I expect by mid-2025, runoff will be over. TLT did not have a good week, down 4.49%. You have a couple of events causing that in the long end of the curve. Number one, CPI did not help. PPI sort of reinforced that. And you have PIMCO, a very large bond buyer, saying we're done with the long end of the curve. We're going to move inwards. So that takes away a big buyer at the long end of the curve. So you can see the 20-year and 30-year rising by 27 basis points, 10-year by 25. More selling pressure on the further out on the curve you go, the more selling pressure there was. SPX down 0.64%. Effective federal funds rate right now 4.58%. If you get your 25 basis points, that'll drop by 25 to 4.33. And the front end of the curve, the 3-month is already reflecting that 4.34. The 4-month at 4.36. You got a 4.32 in here, and the 1 month, 2 month not quite reflecting the full amount yet. Looking at Fed funds futures, Q4 putting in 24 basis points between these two indexes, which call it 25. I'm taking that off the board as that is kind of a done deal, and I'm really only counting these now. Q1 17, followed by another 15, followed by another 10. As far as when I say this many cuts, this is what, if you just take the difference between the indexes, where the index prices are, it's implying that much will come out of the effective federal funds rate. 43 basis points in the first 3 quarters of 2025. I think that is wrong. I think that's wrong. If we're going to end at 3.5, the index should be at 96.5. We're sitting at 96.09 on the October index. I think it should be 90. It should be reflecting 96.5. I think you're going to get more cuts than 43 in the first 3 quarters. So I still think a long ZQ makes a lot of sense. Let's move over to beta. Had a so-so week. Very little desire to push it higher, but very little desire to push it lower. Kind of really just a sideways week. The forward four-quarter operating earnings, 263.39. Little change from the week before. Here's a progression of all the previous weeks. Closing SPX 6051 puts the index below 23. You can say it's 22 and change and not be a liar, but 22.97. Call it 23, right? Week before was 23.12. Implied volatility, the percentile, 13th-week percentile, now the 12th percentile, up from 0, and TLT, the 37th percentile, up from 0. So some risk coming back in. Inverting the PE gives us an earnings yield, earnings over price, and the earnings we're using here is the operating earnings. That's not even the as reported earnings. So when you hear earnings per share, that's as reported. That's not operating earnings. The as reported will always be lower because you have line items that come in below operating earnings. If we buy up everything, this is what we pay. We get to keep, we say we get to keep the operating earnings. You don't, because you still got to pay a whole bunch of stuff after that. That yield would give us 4.35%, or you could buy a 10-year and get 4.4%. So the premium you're getting for being in equities, especially U.S. equities, not that great. As the richness of the U.S. market increases, as the valuation increases, the rest of the world just gets cheaper. I would almost seem to think that now is the time for that kind of contrarian plays to say, well, look, everything's priced in. You're pricing in so much perfection. Just on a yield basis, I can do better in the 10-year than I can in the equity market at a 23 times forward multiple. Keep in mind now that multiple is operating earnings. That's not as reported earnings, right? Those are just operating earnings. So if you use the as reported, you'd be somewhere around 27, 28, maybe even 29 times forward earnings as reported. That would be the earnings that you would get to keep. All-time high, 607.37. We're sitting at 603.85, less than 1% below an all-time high. Once you have the Fed meeting on Wednesday, it probably will be as expected. I don't know that you're going to get much out of the press conference that could derail the end of the year. Markets usually drift higher into the end of the year. For every year that I can remember, I don't know that I can remember a sell-off into the end of the year. They usually just drift higher. Not with conviction, but they usually drift higher. And then for some reason, just New Year's Eve, when you come back, you have so much more optimism. It's like, oh my God, did you hear? President Trump won, and we will price in everything again. Until January 21st when we see what he will actually do. So I don't know that there's much stopping large caps at this point in time. And the AI story really is a large cap story because it relies on big data sets. It really is a large cap story. I don't know that there's much stopping this, even at this valuation. I'm not a buyer, but I certainly wouldn't. I spent some time shorting beta using SPY, and it didn't really work out as well as I would have liked it to. It did allow me to extend long positions that I otherwise wouldn't have done, but I'm getting my short now on IWM, my beta here. Not a good week for the Russell, down 2.45%. IJR, which are profitable small caps, only down 1.35%. And we saw earlier that the SPX had pulled back just a little bit, 0.64. Large caps down 0.64, small caps 1.35. Unprofitable small caps, or a large percentage of unprofitable small caps, down 2.45. I am short IWM. All-time high 242.56. Here 126.73 from November 26th. Looking at the implied volatility last on SPY was 10.2%. Its historical volatility is higher than its implied volatility, up from 9.4%. TLT 13.2, up from 11.1%. Put call open interest on the SPY 2-to-1 2 puts for every call, up from 1.91, and on TLT 0.9, up from 0.76. Earnings, General Mills, Micron. I am long Micron, and let's see what it does there. Lennar, I think it, if you have the applied level from my positions video on Friday, I said I think it might be time to start looking at the U.S. housing stocks. Lennar reports on Wednesday. I'll wait to see what they have to say. Thursday, Nike, FedEx, and ConAgra. And what else you got here? You have Lamb Weston and Darden Restaurants. Let's see how Lamb Weston does. They have had difficulty the last couple of earnings, but they have a new activist on that has a position in the company. I don't know. Maybe they have a different strategy that they're going to announce or something. I don't know. That'll be interesting to see. My focus, of course, will be on what I'm long, Micron, and secondarily what I want to be long. If I'm going long housing, it will be the two big guys, DHI and Lennar. They've had tough going of it for the year. Well, so what do we do here? There are good reasons to be wary of the market, especially on valuation levels, especially at 23 times forward earnings. It seems to be pricing in just a perfect story under Trump. And there seems to be some good reason, I think, to be in duration. All the good news has gone to the equity market. All the bad news has gone to the bond market. That can't be true. You have speculative assets that just keep frothing up to the top. I think you're going to see a wave of convertible bond issues going out to support the crypto space because, well, that's what Wall Street does when it finds a new toy. It plays with it to death. I think it'll continue to do that. Bitcoin, over 100,000. Speculation back everywhere. And I have one more indicator that I'm going to show you here that I think represents, the ultimate in excess, is that all the excess is back when you see this. Look who's back. Tai Lopez. Remember this guy? Here I am in my garage in my Lamborghini. Oh, and my bookshelves. He's back. I was watching a video and this came up as a commercial. I thought, oh, you got to be kidding me. This guy is back. But I guess he's sitting around looking at all these things going up and looking at Bitcoin saying, well, if this much gullibility out there, I'm back. This time, look at his background, though. He's got looks like he's in a small upstairs apartment to a house somewhere. You can see the roof kind of slanting here. So you can imagine that he's in a room with a roof like this. And a solid couch from the Brick or Leon's or someplace like that. I don't really know. And he's just got a little flipboard going on right here. However, in this little commercial, because I had to listen to it, he has some kind of agency that's doing 7 figures. So he's doing millions of dollars of business in his little upstairs apartment with his little brick couch. And he's trying to sell you on the new SMMA 9.0. Tai Lopez. And look at him. He's even got a new hairstyle going on over here. He's back. Unbelievable. Okay, I'm going to carry on with where I left off last week. We're going to look at some crypto fallacies. This is part 2. I'm going to deal with one that I've seen in a number of places. But let me give you some context. I have been reading some books. I've been doing my tour of the YouTube videos. Some of them are just ridiculous. The Bitcoin blogs. The book I'm reading right now, The Bitcoin Standard, The Decentralized Alternative to Central Banking. Here's the one thing I'm finding is that if you read one book, you've read everything, you've watched every video, you've read every blog. Everything seems to repeat the same talking points, and there are these few talking points, and they're taken almost for gospel, and they're repeated by a number of people. And I think that what you have is a bunch of people a whole group of people who jumped right over understanding and landed on certainty. They're absolutely certain about what they're saying with no understanding of what they're saying, but they're absolutely certain about it. That is half the industry, it seems. I'm going to read to you some excerpts from this book about how absolutely ridiculous it is. What I find is a lot of this is propaganda. It's not there to educate you or inform you, but more to indoctrinate you. And when you're indoctrinated into a cult, you tend to repeat these few things. And no matter where you go, you see these same things repeated again and again without question, because there is no understanding. There's only certainty behind it, unfounded certainty behind it. So I'm going to deal with one first as it relates to intermediated payments. And then another one I see repeated a lot if you do your tour of this space. You'll find this one. Money printing causes inflation. Your government, your central banks are printing money, debasing your currency. It's causing inflation. Bitcoin has a fixed supply. It's a hedge against inflation. We're going to debunk that one. Both of these statements are mostly false. And when something is mostly false but sometimes true, then it's true by coincidence. If you increase something and nothing changes, increase something and something increases, increase something and that something decreases. If while you're increasing something you see it in the other thing increase, stay the same, or decrease, then it has no relationship at all. And the evidence for managing the money supply is quite dismal. So we'll debunk that. But first, let's deal with this intermediated payment thing. That is repeated a lot, the idea of a trusted third party, and that the peer-to-peer network behind Bitcoin eliminates the need for a trusted third party. You can eliminate the intermediary. And there are two reasons why that are given, two broad reasons why you want to eliminate that trusted third party. The first one, after I explain it, will be obvious to see why the crypto space is full of criminals and fraudsters and things like that. With an intermediated third party, with a trusted third party, intermediate payment, you may be disallowed from engagement in the system. Banks will, if you're trying to money launder, will stop that. If you are trying to finance terrorist groups, they will stop that. No, you can't transfer money to these terrorist groups. They will shut that down. If you are engaging in criminal activity, they will shut that stuff down. Right? Isn't that what you want in your system? Do you want people to easily finance terrorism? Do you want criminals to have the same access to the banking system and have an easy life of it? Or would you say, look, make it hard on them. These fraudsters, make it hard on them. Don't make it easy on them. Make it hard on them. They're disallowed by the trusted third party. Now, most of the time when you come across this, it just says you may be disallowed. Okay, let's get it straight. Who is being disallowed here? Are a few good, innocent people being disallowed every now and then? Sure, but that's the price you pay. Are there innocent people in jail? Sure, but there's a hell of a lot of guilty people in jail. No system is perfect. There are always trade-offs. I don't want these people in the system. But Bitcoin, you want to finance a terrorist organization? Come on in. You want to launder some drug money into the system? Come on in. You're a fraudster and you want to defraud people? Come on in. You're engaged in crime? Come on in. Any pedophiles in the line? Come on in. You're welcome here too. Anybody allowed. Anybody. This is probably why you have such a large concentration of undesirable people in that space. But let's get to the trusted third party. And let's look at the rhetoric. The rhetoric is how you word something it will determine the type of message that you're trying to get across or what it is you're trying to say. Here is the argument for the elimination of a trusted third party. There's three of them. Number one, a trusted third party is an added security weakness. I see this as security strength, but it's an added security weakness. New possibility of theft. The trusted third party could steal from you. You may be vulnerable to surveillance and bans by political authorities without really saying what those bans are. Again, if you're financing terrorism, yeah. If you're engaging in large transactions, that's usually the footprint of money laundering. Yeah. I mean, if I'm doing nothing wrong, what do I care? What the hell do I care, right? If I'm leaving certain footprints and it looks like the same footprint somebody else does, I want to be distinguished from those footprints. I don't mind showing my work. I bank in 3 different countries, in 4 different currencies. And the toughest country to bank in is Costa Rica compared to Canada and the US. Every time you move money into your account, you must show source of funds. Why? Because they're trying to eliminate all the money laundering. I'm fully okay with that. They're trying to eliminate the fraud and the crime. I am okay with that. I want the trusted third party, but no. New possibilities for theft. Vulnerable to surveillance and bans by political authorities. This one here, intermediate payments always include the risk of fraud. Look, any human interaction includes the risk of fraud. Any human interaction. Dating sites include the risk of fraud, for God's sake. You don't have to go. So they've created this imaginary enemy in the trusted third party. They've raised the level of fear in you to make you doubt it. Oh, I should be afraid of this. And more theft. They're going to steal from me. They're going to defraud. There's surveillance from political. I may be disallowed. Oh my God. They've turned what is an asset, the trusted third party, into an enemy. The trusted third party is your friend. A charge appears on your credit card that you didn't do. You call them up. I didn't do this. Or even better, there's a charge on your credit card that you did do. You bought something that somebody said is this. And you said, fine, I'll take it. But when you got it, it was something completely different. You can call your credit card company and say, this is not what I paid for. Gone. Not on Bitcoin. Why? Because that's where the criminals are. The criminals are there. If you're disallowed from a trusted third party, there is a reason. Most of the 95% of the time, 99% of the time, society doesn't want you. And the trusted third party is just doing a good job. It's a trusted third party, which is an asset. They cast it as a liability. That is indoctrination. And almost everywhere you go and almost everything you read always shits all over the trusted third party. I want a trusted third party. So do you. So do most of the people in the world want a trusted third party. I have never had any of these problems in all of the trusted third parties I've used, and I've used a lot in 3 different countries. I've used a lot of trusted third parties. They've never stolen money from me. They've never defrauded me. And when there is surveillance, you know what the surveillance is, and you know what the reason for that surveillance is. And if you're doing nothing wrong, it's like, okay, I don't mind showing you. If I was money laundering, I'd be saying, God damn it, I can't get into the banking system. This crypto thing sounds really interesting, though. If I were money laundering, if I were a fraudster, if I were a criminal, if I were funding terrorism, what a great system. But when they tell you not to trust that the trusted third party is the problem, no. The trusted third party is the solution to a world in which fraud is everywhere. You don't have to go to your bank to be defrauded and being stolen from. That happens everywhere. If anything, these places protect you from that. They have the security to protect you from that already. I want a 1-800 number to call. I want a trusted third party. It's an asset, not a liability. All right, let's get to this other thing. Money printing causes inflation. And Bitcoin is a hedge against inflation. I see this in a lot of places, the quantity theory of money, and the conclusion. It's really just the conclusion that's stated. Anybody can clearly see that an increase in M leads to an increase in P if you hold V and Q constant. Well, duh. I mean, okay, what you're doing is you're putting in some ridiculous assumptions that just aren't true in the real world, and it misses the point. You don't understand how theory is built. This is a theory. This is the quantity theory of money. And how you build theory is you construct a perfect world first, and then you look for deviations from the perfect world. Any deviation from the perfect world must be because of the variables involved in the theory and nothing more. Let me give you a good example. Does your choice of debt or equity affect the value of your firm? That's a big question. Does capital structure affect firm value? If you say, well, yes, I say, well, how? How? Is it small cap? Is it mid cap? Is it large cap? Is it in high interest rates or low interest rates? Like, there's so many variables that you would look at, it would be overwhelming. The first thing in building the theory, your theory is capital structure affects firm value. Your first step, and this is being done by Modigliani and Miller, your first step is to construct a perfect world in which it does not. You say, well, what would I need such that it wouldn't affect? Well, no taxes. The dividends are irrelevant. Whether a company pays dividends or not, irrelevant. No information asymmetry, no agency costs. So you come up with a short list of things, and they came up with a list of 6 things. And they said, okay, look, if these things were true, then capital structure would not affect firm value. There we go. So we know it does, so it can only be these 6 things. Because if we assume these 6 things, we get rid of the relationship. So if there is a relationship, it's only these 6 things. That's all this is doing. All this theory is doing is saying, look nowhere than these variables. So let's first of all construct a world in which an increase in M results in an increase in P. Number 1, let's hold V constant. V is not constant. But let's hold V constant because we have to make the perfect world first and then look for deviations from the perfect world. Q is exogenous. Well, we know that that is not true. The level of money in the system also is a determinant of the level of GDP. And I can make that argument very easy. So the idea behind monetarism is you manage this, M, to manage this, P. M is the money supply. Specifically, it is the money supply in circulation. Central banks do not create that M. They create reserves. When central bank engages in open market operations by buying bonds in the open market, they create bank reserves. That is not money in circulation. Not until a bank lends it out is it part of the M in this equation. So it is your demand for loanable funds that increases the money supply or puts pressure on the money supply to go up. If nobody asked for a loan, the money supply wouldn't increase. So in essence, it is actually serving a function for you. You got a mortgage? Well, you're part of the problem. Really, within the confines of this theory now, you're part of the problem. V is velocity. P is the price level. Actually, let me change that on the fly. That should be Q. Q is real GDP. The combination of these two is Y. We got to get our algebra letters right. So you manage M to manage P. I don't think that's not a controversial statement. Anytime you manage the supply of something, you do affect the price. De Beers controls 80-90% of the diamond mines in the world, and there's no shortage of diamonds, by the way. There's shortage of diamonds in circulation because they manage the supply of it. They leave most of it in the ground so that it does have the value it has. OPEC. OPEC used to be more powerful than what it really was, but it represented the petroleum exporting countries. When they were a significant factor, they didn't like the price of oil. They would cut supply to change the price of oil. You manage supply, you manage the price. That seems to make sense. Let's manage the supply of money to manage the price of money. Very linear and very causal relationship. It does not, within it, take into consideration the trade-offs. And in a complex system, because that is what we have, there are always trade-offs. You have to think about the trade-offs. And I'll show you what the big trade-off here is shortly. So Here is what monetarists advocated: a constant growth in M. They did not. Monetarists did not advocate a fixed M, but a constant growth in M, leading to a constant growth in P. They also did not advocate no inflation. They did advocate a moderate level of inflation. You can have a moderate level of inflation if you have a moderate level of growth in the money supply, holding growth in Q constant. Did not work well in practice. This was in the 70s. The Federal Reserve was monetarist, managed the supply of money. Did not work out well at all. Even Friedman later acknowledged that that the theory did not work out as well as he had hoped. Simply because in the real world, V is not constant and Q is not exogenous. So the theory, if we're working with pure theory, this is what we would say. If we see an increase in M and we do not see an increase in P, it must be because of V or Q. That's the takeaway. That's the takeaway. The takeaway is not an increase in M leads to an increase in P. No, sometimes it does, sometimes it doesn't. Sometimes it leads to a decrease in P because you have V and Q. Here's the big problem with this equation. There is no demand in this equation. You have supply, but where's the demand, right? Demand is held constant. V is the demand. Change in D is a change in V, and that is held constant. So think about an economy where unemployment is decreasing. People are getting jobs. And people in here say, well, now it's time to, maybe buy a new car. Maybe buy some durable goods. Maybe get a house. So what do they want? They want loanable funds. They want to get a mortgage. Now it's the time to upgrade, maybe buy a car. They want loanable funds. That increases M. It is that increases M. If you disallow that from happening, you disallow growth. Because if they cannot get a new car, then a new car is not made because they can't afford it if they can't get financing. If you don't have a mortgage for a house, well, then a house is not allowed because you can't get it. So if you control M, what you're saying is we're going to control the amount of cars and new houses that are built simply because it is commercial banks that determine the level of M. So you're basically saying we're going to control the amount of money that central bank or that commercial banks can lend out. You are basically controlling growth at that point. You are basically holding growth back. But what if you could increase the money supply without any increase in inflation? Wouldn't that be a better way to go? You watch it happen. You say, okay, as soon as you start seeing inflation show up, you say, okay, now we should do something to rein this in, as opposed to have it in ahead of time. It ignored demand for money. And if you fix the money supply, you really screw up the economy. So this didn't even work well. What central banks did is they switched from a linear function to a complex function that involved a trade-off. This is the Taylor rule. So rather than managing the supply of money, they managed the price of money. The price of money is the interest rate. That is the price of money. Why? Because if you need to get $1 from me, it's going to cost you something to get that $1 from me. That is the interest rate, the price of money. And when money has a price, it also has a time value, the time value of money. And if you understand the time value of money, you understand that almost anything can be a hedge against inflation, for God's sake. Almost anything can be a hedge against inflation. If you stick money in your pocket, and you say, well, it's not holding its value. It's like, well, come on. I mean, you're missing the point of the price of money. The price of money is your hedge against inflation. Anyways, here's your trade-off. Here is your output gap. Here's your inflation gap. Here's your inflation target. Here's where inflation is now. Here is your potential GDP. Here's where GDP is now. And we have a trade-off. This is full employment. This is price stability. There are the two mandates of the Federal Reserve. These are trade-offs. That takes into consideration a complex economy. If we have an economy performing below its potential, we don't have full employment. There are people out there who want jobs, who want better lives, and there are people out there who want higher paychecks. How do we get that done? Well, we encourage more economic activity by lowering the price of money. If we lower the price of money, we increase the demand for loanable funds. We increase the demand for loanable funds, more cars, more appliances, more furniture, more houses. If inflation is running too hot, well, we better raise the price of money so it lowers the demand for loanable funds, fewer cars, fewer houses, fewer appliances, etc. And that'll take inflationary pressure off. Manage the price of something, let the supply take care of itself. In fact, you're not even managing supply at this point, you're managing demand. When you manage supply, you end up with all sorts of problems. Let's have a look at some charts. Okay, let's start with M2. This is the M that fits the definition in MV equals PQ. And you can see that it has increased over time. This increasing over time is a good thing. If you laid this over the growth of nominal GDP, you'd see it tracks very well with nominal GDP. And then you had this throughout the 2000, from past the great financial crisis onwards, you had a nice increase in the supply of money over time. And by the way, during this period of time, you had almost no inflation. In fact, you had a few bouts of deflation in the US while the money supply was increasing. So it cannot be true that an increase in the money supply leads to an increase in the price level. You had this massive increase in the stock of M2 and a bit of a decrease over here until we're back on what seems to be a trajectory. The slope of this line is less than the slope of this black line. So at some point in the future, they will meet, meaning that the extra stock has been worn off over time and is right where it should be if we stayed on the same trajectory. So just so that we can see that M2 pretty much increases, right? All right, let's look at velocity. Is velocity constant? Doesn't look constant to me. Look at that, peaked at 2.2 in the about 96, 97, straight down to 1.5, and we're currently at this point in time below the 1.5. If you go back in time, Friedman mid-70s when he was observing, you could be forgiven for thinking that the velocity of money was fairly constant, because it did hover in around 1.7 up to 1.8, down to maybe low 1.64, 1.65 up to 1.8, tight range. But then it really went after that from the mid-80s to the mid-90s up to 2.2 and then straight down. This is lining up with the generations. That's about the peak period of time where boomers were about 45, 46, a very large generation. Spending usually peaks around 45 because usually the house is bought, the furniture is there, you're not changing your vehicles every couple of years, and the kids are out of the house and gone to school, gone to university. So household spending usually peaks around that time and then drops, and you could see it significantly dropping off here until you hit you start to see the boomers retiring from 2010 onwards. You really see the continuation and the drop in the velocity of money. So there is a change in velocity over time. Keeping it constant warps the conclusions you get. Keeping it constant is only in a perfect world. So this does change over time. Let's look at how, let's see, we looked at M2. Let's look at this one here. This is another way of looking at M2. This is the change. This is a percent change from a year ago, because you are hearing claims out there, especially from sailor money supply increases at, 15%? Here's 15%. Only once in the last 45 years, really, did it breach that amount, and that was during the pandemic. And to correct for that, you actually had negative growth over here. Even saying that it grew at 10%, only in times of stress did it grow at 10%, and this is where you want to see it in recessions. Milton Friedman even said one of the exacerbators of the Depression was a policy mistake from government by not increasing the money supply. Had they increased the money supply, they would have made it easier, or it wouldn't have been as bad. But they didn't increase the money supply, and that is what happens with a fixed money supply. Is you end up with very bad outcomes. The growth is usually around 6%. Long-term average usually around 6%. Sometimes it's higher, sometimes it's lower, sometimes it's higher, sometimes it's lower, sometimes it's higher, sometimes it's lower. But the attractor point is right around 6%. But in most of the places that are pro-crypto that have actually brought up the growth in the money supply, I've seen numbers from 10 to 14 to 15%, and it's just not true. It's about 6%, which is about the growth of nominal GDP. Let's have a look at GDP. GDP is in here somewhere. There we go. Here's real GDP. If you go back to 55 to about 65, it would peak up around 8% with an average somewhere around 6%. If you go to the next decade, it would peak around 6% with an average somewhere around 4%. If you go to the next decade, it peaks around 5% with an average of around 3.5% to 4%. And now it's peaking at around 3% with an average somewhere around 2%. That's about the Fed's target when you look at the summary of economic projections of where they think the long-run trend of GDP is, about 1.8 to 2%, which is the middle of the range. We have this nice step function down from about 8% peak to 6% peak to 5% to 3%. So we have this step function down in real GDP. You have an increase in the money supply. You have a decrease in the velocity of money. And here is your inflation. We can just ignore this part in the 70s. These were supply shocks. But if we go to the 80s, you're sitting somewhere here a little over the 1% mark. This is this is quarter over quarter. There is 1%, peaking at 1% quarter over quarter, which would be about 4% annualized. Look how much lower. Look at during this period of time how low it was. This is changes in the price level, increases in the price level. In fact, you had increases in the money supply during this period of time, but look at this. Without a recession, you had 2 quarters of deflation in here. You had another quarter of deflation in here. That's very bad news for an economy. To have deflation, because with deflation, it's the same as seeing the price of your currency increase. And you think, I'll wait another couple of days, it'll go up even more, right? You're looking at your Bitcoin, 100,000. Well, look, it'll buy double what it could buy based on the beginning of the year. In January, it's 50,000, 100,000. You could spend it now. You say, no, I'll wait for it to go higher. That's the same thing as saying, no, I'll wait for prices to go lower. It's the same thing. That is bad news for an economy right there, deflation. But there it is right there. You have a very weak relationship between M and P. Why? Because V is non-constant and Q also depends on M. I've already explained that. If you have a fixed M, you probably have almost no loanable funds, or the cost of loanable funds would be way too high. You have fewer cars being made, fewer houses being built, so real GDP drops. So real GDP is in part determined by the growth in the money supply, and the relationship between growth in the money supply and the price level is I wouldn't say quite random, but the relationship is very weak. It's not a linear relationship because it ignores V, which is demand. Let's look at Bitcoin. Here's Bitcoin. Here's the S&P 500. Notice the S&P 500. This is April 20. Here is April 20 as well. And this goes to October 24, October 24. I've lined them up as best as possible. You had this run up in the S&P, and then when inflation showed up and rates started to increase, you had this pullback in the S&P, and then you had this run up. You had this run up in Bitcoin, and when inflation started showing up, you had this pullback. Those two things look kind of close to you. This is a risk allocation, not a hedge allocation. It's a risk allocation. It just so happens to be going up with other risk assets that happen to be going up when inflation is elevated, which is just a coincidence. It's not a causal factor at all. In fact, if I overlay inflation on this, it really went like this, and then it really went up before it started to come down. And when it really started to go up, and the central bank said, okay, let's deal with this. Let's raise the price of money to decrease the demand for loanable funds. Usually when that happens, risk assets don't do well, and it did not do well. So look at the pink line, look at the white line. Did this respond more like a risk allocation or more like an inflation hedge allocation? I mean, it is what it is. It's a risk allocation. Let's stop calling it a hedge against inflation. Almost anything can be a hedge against inflation that is going up. If you last year bought US dollars, if you were in Canada and you bought US dollars, you would say the US dollar is a great hedge against inflation, because it went from $1.34 Canadian to $1.43, more than outperforming inflation. The US dollar is a hedge against inflation. So on a relative basis, almost anything can be a hedge against inflation if your only measure is it went up. It went up by more than inflation. By the way, in a competitive economy that has money that has a time value, if you can't outperform inflation, there's something wrong with you. You're just not trying hard enough. Outperforming inflation is not hard to do. Now, not everybody can do it, but if you have money and you're just leaving it in your pocket or you're just leaving it in your bank account, then yeah, of course, but you're missing the point. The store of value is in the time value of money. Money has time value. If you're not going to take advantage of the value that's sitting there, well, of course you're going to lose out. But it's easy to outperform inflation. My God, it's not difficult to outperform inflation. That you have to create a whole superstructure of an imaginary currency to get it done, to me seems like a ridiculous thing. Okay, I'm just going to get rid of the bottom part of the screen, and let's think again about MV equals PQ in the confines of that, and why fixing M would be absolutely horrific. Let's look at this Bitcoin chart over here. This is 50,000 near the beginning of 2024. We're at 100,000. Let's say at this point in time, I decided to hire you, and I'm going to pay you $100,000 of purchasing power a year. So I look at the price and say, okay, well, that's 2 Bitcoin. I'll pay you 2 Bitcoin a year. Now, we're looking at an exchange rate. So we're looking at the price of one thing relative to the price of another, which is the US dollar. So the US dollar is being held constant while the price of Bitcoin can fluctuate. I want you to imagine now a world in which there is only this Bitcoin, and we don't know what its US dollar value is, but we can determine what its real value is. And let's say this 2 Bitcoin, let's say I'm an auto manufacturer, and this 2 Bitcoin is equivalent to 3 1/3 vehicles. Each car is $33,333. Actually, sorry. Let's say it's equivalent to 3 cars. Each car is $33,300. So when I hire you, I think about, well, what is the real cost of you to me? I got to make 3 cars and sell 3 cars to pay for you. Okay, good enough. I know how much it costs me in real terms, because keep in mind now, I have no other reference if I want this to be my currency, right? If I'm looking at it in relation to another currency, I may as well just pay you in that other currency rather than saying 2 Bitcoin. I'm paying you 2 Bitcoin. And at the end of the year, we're all the way up here. And again, we need something to compare it to. I'm comparing it to a real value here, but it has doubled in value. So at the end of the year, your 2 Bitcoin can now buy 6 cars, because we are leaving the supply fixed, so only the price can increase. So now we can produce 6 cars, and I say, oh, you're starting to cost me too much money because I have limited production capacity here. You cost me 3 cars of production at the beginning of the year. Now you're costing me 6 cars of production. I got to lower your salary to 1 Bitcoin. Now, if we think about in terms of dollar value, just to put that back in there, I did agree at the beginning of the year to pay you 100K. If I lower your salary at the end of the year, it's still 100K. But we don't have this reference point. We just have this real point that I look at. I, as a producer, can see what I can put out there. And now you're costing me 6 cars. I simply can't afford that. You don't want your pay cut, I'll have to fire you and hire somebody else at 1 Bitcoin. But wages, the wage level would go down. You would find it hard to get a job somewhere else for 2 Bitcoin a year because somebody would say, that's 6 cars a year. Let's say Bitcoin goes to 200,000. The value goes to 200,000, and I lowered your wage to 1 Bitcoin back to 3 cars. Now you're back up to 6 cars. I can't afford you. I got to lower your wage back down to 0.5 Bitcoin. So what are you getting when you look at wages in the economy? They're going down. You're getting wage deflation. However, it's still maintaining the same purchasing power, but you're getting wage deflation. But you may say to me after 1 year, but I'm worth more to you now. Isn't that justification for a raise? And I get that, okay, it was 3 cars, now it's 6, that's fine. But at the beginning of the year, I was earning the equivalent of 3 cars. Can I not now earn the equivalent of 3.1 cars? Am I not worth more to you? I say, okay. I have a number of people working for me who are making this argument. And I say, okay, well, out of the 10 of you, I can give 9 of you a raise, and I got to fire 1 person. Why? Because who am I going to get it from? There's only 21 million of these. You want more, you want more, you want more, you want more, you want more. Great. Where are we going to get it from? We got to get it from somebody else. It's a zero-sum game at this point. You want more, I got to take it from somebody else. Somebody has to be fired. Gone. If they were making enough, because gross domestic product is equal to gross national income. If they were making enough for 3 cars, then there's 3 cars less, because you're not going to buy 3 cars more. There's 3 cars less being demanded because they don't have a job. The more, now these 9 maybe next year say, well, we want a raise as well. Well, 8 of you can get a raise and 1 of you has to be fired. And companies everywhere would be faced with this, that my experience should be worth more. But there's only 21 million of these. That no matter how much value you create, you can never increase the amount of currency in place. No matter how much we could increase GDP by, the amount of money in circulation would never change. Now think about what the cost would that be. Once you manage the supply of something, you manage the price of something. How much do you think it would cost to borrow that money? What would the interest rate be to borrow any money whatsoever? It would be exorbitantly high. It would be really high because there's only a limited amount. That's the problem with limiting your currency, is you shut down the growth in your economy. Now I'm going to layer on one more very bad thing. What if somebody came along and said, I'm going to start buying this stuff up. I'm going to start collecting this and I'm never going to share it. My velocity will be 0. My velocity will be 0. Pretty soon there'll be 20.5 million. Then there'll be 20 million. Then there'll be 19.5 million. And it will be harder and harder and harder for me over here to give you a raise because I got to get it from somebody else. I have to get it. And if this money's being taken out of the economy and being hoarded, what are you going to do? You can't print more. I got to come up with something. I got to get it from somebody else. So it becomes even tougher to find out where you're going to get your next bit of currency, simply because everybody wants more, but there's less and less and less. So you could have a few people who are very competitive in an open economy, who do very well, who control everything, and a whole bunch of people who have almost nothing. You would have massive unemployment. You would have probably a 0.1% and 99.9% kind of division like that, because you could hoard all the money. Now your money is not being controlled by a government any longer, but it is being controlled by private individuals and private corporations. Private corporations with the expressed intent to control the supply. Do you see how bad an outcome this is going to be? Do you see how absolutely ridiculous it would be to even entertain the idea of this as a currency? It's not a currency. Stop saying it's a currency. It's not a currency. You don't want this to be a currency. The probably most ironic part of this is most of the people who are advocating for crypto tend to be people, based on their comments, tend to be people that have an external locus of control. These are the people who are the least equipped to compete in a competitive environment with a fixed money supply. They are most likely to be the biggest losers in an economy with a fixed money supply, advocating for their own destruction at this point in time. If you are having a tough time with a growing money supply in capitalism, which is competition, you're dead in the water with a fixed money supply. That is the worst thing you want. That is the worst possible outcome. If you are falling victim to the propaganda of this space, if you are believing the misinformation in this space, you are being driven into the hands of the fraudsters and the criminals. You are least likely equipped to be able to keep the money that you make in that space. You should be against this kind of thing. Rather than for this kind of thing. In upcoming videos, I will explain what part of all of this is tulips, what part of this is .com. The tulips is something we can do without. The .com, maybe there's something there because something was born out of the .com era. I'm also going to explain why, no matter how much you want to talk about your technology, no matter how elegant you think your solution is, no matter how good and solid you think it is, no matter how much infrastructure you want to point to, it doesn't matter. None of it matters. I'll spot you all the technology. I'll say, yeah, your technology's fantastic. I'll give it to you. I won't even go there. I will give it to you, and I will explain to you that it doesn't freaking matter.